Hello, everyone. Thank you for joining us for today's event featuring Mary Childs speaking on her book, The Bond King: How One Man Made a Market, Built an Empire, and Lost It All. My name is Srish Chatterjee, Professor of Finance and Business Economics at the Gabelli School and Gabelli Chair in Global Security Analysis. It's my pleasure to welcome you on behalf of the Gabelli School. And to many of you who are in the audience today, who had joined us a few weeks back for this event, I gratefully say welcome back. The Gabelli School Centennial Virtual Speaker Series began in 2020, marking 100 years of purpose driven business education at Fordham. In the last year, the Gabelli Center for Global Security Analysis and our wonderful partners, the Museum of American Finance and CFA Society in New York, have sponsored more than 50 events that have drawn 8,000 plus attendees. We are tremendously proud of this dynamic partnership, and a full archive of our video content will be shared in the thank you email you will receive. In just a moment, David Cowan, President and CEO of the Museum of American Finance, will give a full introduction to our speaker. Ms. Childs will deliver a presentation for about 40 minutes, at which point she will address questions submitted through the question field that is located below the video player. Please feel free to submit questions at any point during the event. We will be addressing as many of them as possible during the session. I also want to share that all attendees of today's event will be receiving digital copies of Ms. Child's book with information coming to you following our event. Before I turn it over to David, I want to warmly ask that you consider making a donation to the Gabelli School's Centennial Fund or to the Museum of American Finance. You can make a tax-exempt gift quickly and securely online at the links provided in the chat. And now, without further ado, I turn it over to David Cowan.
Thanks, Sarish. Great to see you, our friends at the CFA, and of course to see Mary yet again. The Bond King is a very enjoyable read. It's easy to see why this book and audiobook is topping the charts on books about bonds at Amazon. So please enjoy these ebooks that are being so graciously provided for by Fordham. Now, everyone in the markets knows about PIMCO and Bill Gross. He and the firm were ubiquitous. The rise and fall was front page news, and Mary, in her work as a Bloomberg reporter, was assigned the task of finding out the real story in 2014. Well, we have the results some 8 years later, as she was ever careful with her sources, logging thousands of hours of interview, and the result, this book, is a definitive picture of the man and the firm. And the author's notes, there's something I haven't seen before, which is where Mary addresses some of the wild rumors about her while she was writing the book, so please don't miss them for entertainment. Mary is co-host of the very popular NPR podcast Planet Money. She was a reporter for the FT, for Bloomberg and Barron's. For all things Mary, go to marychilds.com, and there you can sign up for her newsletter. Two final thoughts. Wall Street reporter Greg Zuckerman is referred to multiple times. That brought to mind that he was our last person at Fordham live some 2 years and 2 months ago. So here's to hoping we can get back to live again in the fall. Lastly, this book was all encompassing for Mary, and she concludes the acknowledgments with a tribute to her husband, saying that they could finally now go on their honeymoon. But what we learned last time was that launching a book is also all encompassing. So I don't think exactly that has happened yet, but it's my pleasure to introduce Mary Childs.
Thank you so much. It's my honor to be here twice. Thank you for having me. And yeah, still chasing that elusive honeymoon. I'm sure we'll get there one day. I have had a really great time going to Las Vegas, but my husband didn't get to come with me, in Chicago, but my husband did come with me. So soon, I'm sure. Yeah, so I think this program and kind of the mission of the Museum of American Finance, there's so much overlap with kind of the mission of my book and what I set out to do here. The goal here was truly to kind of tell the story of the bond market through the story of Bill Gross and PIMCO. And I started covering PIMCO, as David mentioned, as a beat reporter in 2014 in April. And, I'd covered credit before that at Bloomberg News. So I had some familiarity and some understanding of what I was getting into. But I thought that, Mohamed El-Erian had left in January 2014, and it had seemed like this big explosive event. There had been that Greg Zuckerman article with Kirsten Grind in the Wall Street Journal, among others. And I was like, oh no, like I missed the fireworks. I missed the big story. Oh, well, this is still a really great beat and this is a great company to cover. And I was excited. But then, of course, I had not at all missed the fireworks as Bill Gross's departure was yet to come. So this story kind of landed in my lap in that way. And I'd also for years, having covered credit at Bloomberg, Bloomberg's, I think, institutional stance was that bonds are more important than stocks. And I think I took that to heart and just wrote that into my own DNA a little bit. But I kind of had this chip on my shoulder as a result of that, the bond market's misunderstood, that, this is so much more important than it's given credit in the mainstream, so to speak. And, it's more important than, I would argue, the stock market, although I've gotten some pushback. Try going on the Motley Fool podcast and telling them that stocks are silly. I don't recommend it. But there is, this sense, I have this very strong sense that stocks are more accessible and that bonds aren't accessible for retail investors. And therefore, there's kind of less of a direct connection. And I think that's fair. But to me, the bond market is where things happen. And so, this story of Bill Gross and PIMCO ended up being truly the perfect vehicle for this kind of, you get in the car with me for this journey, for me to tell you this long story of the rise, the fall, how one man made a market, built an empire, and lost it all. But along the way, you learn the entire story of the bond market and how it came to be, as it is today. And you're not supposed to really notice that educational journey because the car ride's so fun. You're just, by virtue of being in the car, you'll learn more about the bond market and come away understanding it. And so that's kind of the fundamental motivation behind me writing the story in the first place. And then I also, it was kind of, Bill Gross is a perfect subject because he's so mediagenic, and we'll get more into this later. He so loved fame and wanted so much to be famous that meant, as a journalist, I had decades of Bill Gross musing in public about his shortcoming, his challenges, his ambitions, what the market was doing, of course, what the Fed was going to do, all of these different things. And that's just content for me to mine. And that was a huge blessing because it is kind of this snapshot in time where I can talk to a person today about what they think they thought in the 90s, but it's so much better to hear from that person in the 90s insofar as that's possible. So that, and the kind of existing framework that the story provided of a classical Greek tragedy, where you have this this true rise and fall, you have a little bit of hubris, arguably, and you do have I think the characteristic that's most often missing to make it a perfect Greek tragedy is that recognition at the end of shortcoming, of the fatal flaw. So it's King Lear, it's all of these things all at once. And so I feel very lucky to have gotten to kind of chance into this wonderful story and be able to tell this larger history of the bond market. I will say I abbreviated that larger history. There was a time when this draft was 200,000 words, and it included the Thomas Paine pamphlet on we should have pensions for. It was not my best work. So I think we're all glad that that's not what made it into the final draft. Just enough history of the bond market. So I think I'm going to break Bill Gross's legacy into, I think, 5 parts. It's 4 and a bonus. The first one is Bill Gross as kind of an OG influencer before we had the words to describe it as such. He was great at branding. And as I mentioned, he loved fame and was always very interested in being famous. So that, I think, was unusual at the time and was definitely, he was sort of a trailblazer in that way. And I think you've seen a lot more people follow in his footsteps in that. So the kind of other ways in which he really, the things that I think will endure as his legacy are he helped to invent active bond trading. And that is obviously hugely consequential. He's talked lately about how capital markets and credit are full of risk now are a casino, and he kind of helped to do that. So that's been interesting to see. I think his invention of structural alpha, what he called structural alpha, is hugely innovative and helps to build that legend of the Bond King. To me, that's a foundational part of his legend as the Bond King, and I'll break that down a bit more. I think also his very personality has helped to shape the bond market and American finance. That his aggression in pushing boundaries, his aggression in being detail oriented, and in really choosing where in the like fine lines of mandates and government regulation where he accepts the line, where in the gray area of those things he's comfortable just kind of sitting down and waiting until someone tells him it's not okay to be there. And finally, the strategy of shake hands with the government, which again we'll get into more in a second. That was a crisis era thing that they did, and that they were very public about, and that I think is so hugely consequential. And in part because I think just so much was happening at the time, it breezed by in a way. And so I'm glad to have the opportunity to kind of revisit that and bring it back to the fore. So I think the true legend of Bill Gross begins, this isn't like a true autobiography in the sense that I like went to his childhood home in Ohio or whatever. That stuff didn't, seem that pertinent to me in terms of the shaping the person that we know today. And if the structure is looking at the bond market, the Babbling Creek behind his house was interesting in his investment outlooks, but didn't feel like my starting point. My starting point was truly when Bill Gross read Ed Thorp's book, Beat the Dealer. And this book, if you have the chance to talk to Ed Thorp, I encourage you to take it. He's just amazing. Truly like a hilarious person, and just such a clean thinker, just a really wonderful mind and person. So he wrote this book called Beat the Dealer, and it's about counting cards and using a system to count cards and figuring out when you have the odds in your favor and when you should increase your bets. And, Bill Gross had gotten into this really bad car accident as a senior in college, and he was stuck in a hospital bed for a very long time. And as a result, he just like read this book and didn't believe that it was true, that the strategy would work. So he practiced sitting in his hospital bed, bored to tears, practicing hand after hand of blackjack. And he realized that indeed it did actually work. So famously, he went to Las Vegas and counted cards for 3 months, turning $200 into $10,000. He would later reflect that this was a pretty miserable return on investment given the time that he had to spend. But as someone just getting started, it did end up being fruitful for him. And not just in the monetary sense. To me, this investing legend, this part of his legend is so important. This Vegas chapter sticks with clients in a way that I think is really powerful. People found it really charming and interesting and like accessible, that there was this guy who could beat the dealer, who could go and beat the casinos, could beat them at their own game. And that too was instructive for Bill Gross in a sort of literal sense. He realized that if you know what your benchmark is, if you know what you're competing against, and you know the system and you know the odds, you can beat a machine if you have a good system. And that means too, he learned to feel the odds and to know when when the table was hot and when to lean in and when to lean out. And those are absolutely crucial in investment management as well. And I think, to me, it's pretty funny that, some people in investment management really will not tell you that investing is like gambling. And a lot of I think fewer people will tell you it's basically the exact same. We just did an episode of Planet Money that featured Aaron Brown, the researcher and author, and he was like, oh yeah, no, it's identical. It's fundamentally the same thing. So I find that, Bill Gross is obviously very much in the finance is gambling camp. And I, for one, think that makes a lot of sense because, if your job is to beat this benchmark, Bill Gross figured out too that in finance, he just needed to come up with a system, a strategy that would work and stick with it, and to know not to bet too much. And to also know that if it was going against him sometimes, like, that's just what happens. That's life. Even a perfect portfolio will underperform in a given period of time. So you just need to stay at the table long enough to get the true odds, and your strategy will eventually reveal that 51% advantage. So, in finance, the kind of analog, the comparable idea is if your job is to beat that benchmark, this like static or relatively static index, a basket of securities, and that's kind of how you're graded as an investment manager, is against this benchmark. And all of your peers are too, and you're also kind of graded against your peers. But if you know what's in that benchmark, you can figure out how to beat exactly that. You have a very constrained universe of what you're trying to beat. So it's just a game. The only game is to beat that benchmark. And Bill Gross figured out that he could do that by simply observing what was in that benchmark and then taking a little bit more calculated, informed risk than that benchmark was taking and collecting the risk premium for that risk. So, if you're playing on this playground and you want to do bigger, do more, you just expand your universe a little bit compared to what you're competing against. Just make your sandbox bigger than their sandbox. Buy things that aren't in the index. And then crucially, when those things get added to the index, everyone else is going to come rushing and you'll be like, oh, great, I'm already here. I've been collecting this risk premium for ages now. And then you will also enjoy that kind of wave of buying as people enter the market. So this is also kind of presaging the government trade, the shake hands with the government trade that came in the crisis. It's, do what everyone else is going to do, but get there first. So, that I think this is also in the recent Planet Money episode. Sorry, for those of you who have listened to it, I feel bad being redundant. But there was this concept that one of the kind of most colorful characters in the book, Ben Trotsky, would say, and he called this idea of trying to game the long-term performance. Occasionally sacrificing short-term performance for that longer-term performance. He called this strategic mediocrity. It's the idea that you never wanted to be number 1, 2, or 3 in a given year because that necessarily meant that you would have taken too much risk in that year, that you had done something kind of dumb and reckless, but you'd lucked out, it worked out, and you were number 1. But if you kind of ramped down how much risk you took and didn't make that kind of reckless and poorly informed maybe decision, you wouldn't be number 1 in a given year, but you'll be number 1 over 10 years. And spoiler alert, it did work out for him. His strategy works, strategic mediocrity. And this is, not kind of a revelatory concept in investment management, but I think the way that he thought about it and talked about it is very PIMCO and is very, I think, instructive. And I think it kind of helps, in all walks of life, in all areas and industries. It's just like survival bias in a way, and just making it through to the next day, making sure you preserve your chips so you can come back to the table the next day, avoid ruin, as card players say. So, that is, the kind of sandbox example too of expanding the universe that you're using relative to what you're competing against. At PIMCO, that meant, embracing new products before they came to market or became incorporated into that index, which includes, emerging market bonds or mortgage bonds. They were a very big player in mortgage bonds long before other people were interested or comfortable in investing in the same. And derivatives. I think they had a very enthusiastic embrace of derivatives relative to their peers and sort of found ways in which they could use derivatives to knit leverage into their portfolios and into their funds without breaching that, mutual fund sensibility of not using too much risk and too much leverage. So if you just kind of knit it in a more subtle and discreet way, it's not like, oh, here I've taken a bajillion% risk. It's just quietly kind of running in the background, a persistent way to scrape out extra basis points. And, that works very well when things are good and when markets are going up, which for the duration of Bill Gross's career, they substantially were. So, and this is a bit of a random side point, but I just love it. Bill Gross would print out or have printed the holdings of Total Return, his flagship fund, every day. And it was like in this binder that he physically would like leaf through. And I think this is so interesting and instructive. People told me this as if it was kind of like a weird, isn't this guy a little bonkers thing? But to me, I think it makes so much sense because there's this difference between, I was looking into it because I think personally, like if I'm reading an email on my phone versus even on my laptop, I am so much more dismissive on my phone. I just scroll and I'm like, yeah, whatever. I'll get to it later. I'll focus on it later. And maybe that focus never comes because I already read the email on my phone. But if you print things, you actually retain the information substantially better. And there's this other weird thing where if you read something digitally, you actually, studies have shown that you might be overconfident about your understanding or knowledge of the thing that you read. So again, it's that scanning sensibility. You're like, yeah, whatever. And I just think it's like really interesting and a bit I don't know, cool that it's not good for the environment. So I don't know that I would necessarily recommend printing out the holdings of a $300 billion fund every day. But I don't know how many trees that is. But I think, if you're going to retain, 25% more because you actually kind of had a haptic engagement with that information, that might be worth it, if you plant a whole bunch of trees afterwards. So, on to Wall Street Week. So if you were on Wall Street in, the 80s, 90s, and if you have anybody on your desk who was, you've probably heard of Wall Street Week with Lou Rukeyser. This was a very famous show. People would, end their weeks working very hard in the markets and investment banking and whatever. They would go home, they would cook dinner, and they would tune in to Wall Street Week. It was on PBS, and I just love the idea of like a PBS show being just the absolute like must-see TV. Like, I love that world. And Bill Gross says that appearing on Wall Street Week is what made him famous. I tracked down the producer who booked him, and it was actually just this kind of wonderful happenstance where someone was like, it was kind of there was like something happening in the bond world, and he was like, I need a bond guy, and he like randomly grabbed someone in the hall, and it was someone like Peter Lynch. I don't want to tell you it was Peter Lynch, but it was like, he was like, hey, who should I get? And they're like, this guy Bill Gross sounds like a real up and comer, call him. So in a sense, this is just like the normal way that TV booking happens. It's just like, who should I call? But it's also perfect, right? Which is also kind of, you end up, it's a bit self-fulfilling where Bill Gross was kind of the guy in bonds, but also he was so excited to be the guy in bonds. He wanted to be the face of the bond market, and being on Wall Street Week as the face of the bond market helped that to become true. So, this goes to a very foundational thing about Bill, and it goes to this preferred question that he had when he was interviewing potential PIMCO employees. He would ask them, which do you want, money, fame, or power? And, he liked this as an interview question. PIMCO always prided itself on having very difficult interviews, as a lot of investment firms do. And, one of the things that he liked about this question was that it made everyone really uncomfortable. And he felt like it opened a vulnerability, that they would have to share something and be vulnerable in a way. And, to him, the right answer was always fame. He wanted to be famous from the get-go. He wanted to be extraordinary. And he found that he could do that best in the bond market, which was a bit random. It was kind of an accident. He actually wanted to be in stocks at first, which is very funny to think about. But this idea that he wanted to be the best bond manager in the world, that was his goal, that would deliver him to the fame that he wanted. And, there's a lot more on this in the book, but basically he told me that he equates fame with love, and that he kind of traces it back to his childhood, to his cold Canadian parents, that they didn't hug him or really weren't that affectionate. And that's in part why he feels this need, this compulsion to put himself in the press, to get headlines and to, TV interviews, and to get that public adoration, to kind of fill the void, to fill that hole in his heart. So I think that when you understand that framing of Bill Gross, his actions make a lot more sense, I think. So, this is also part of what I think his legend is and what I think his power was. People can tend to look down on this kind of element of being in the press and seeking fame, or going on CNBC and Bloomberg TV. People can think that that's like, a shallow part of the job, and sometimes it is. But I do think that the degree of utility in business building is a little bit undercounted, where the yield of it, so to speak, is that you have a lot of clients who are super loyal, who are interested and think, oh, this is the guy. And that kind of brand loyalty is helpful in creating a sticky business, and in creating a business that will, that clients want to stick with. And even if you're having one of those stretches where things aren't going your way, they still trust and respect you because they, were brought in by this idea of you as the face of the bond market, et cetera. So I think that, this helped Bill Gross's brand and PIMCO's brand, and helped to build kind of a sticky business, and stickier, loyal clients. So, they called themselves, and I think Wall Street coverage also called them the beach. They had this kind of pride about it. We move Wall Street west is one of the things they would say. I think that's on their self-published history book. And, for a long time, for almost the whole time, Bill Gross's brand helped PIMCO's brand. Those two were aligned. Their interests were aligned and almost synonymous. And that, obviously diverged in 2014, which we will get into. So, thinking about the things that he put forward, he had this folksy and weird investment outlook tradition where he would start these monthly missives to clients and everybody with adorable stories about his, the Babbling Creek in Ohio, his son playing baseball and like being bad at it, and they were like of varying degrees of weird, and indeed he's kept this tradition up, but these were really like accessible. A lot of the times the stories are like embarrassing or endearing because they feel like an overshare. They feel like he's sharing a vulnerability. And so there's this like, I don't know, parasocial bonding happening too. And it sort of lends this like fund managers, they're just like us. And there was also this very influential article, the one that actually coronated him as the Bond King, in which he was doing yoga. And, he's in tree pose in the pictures, he's in feathered peacock pose, he's upside down. And it was kind of, yoga was like new and exciting at the time to the Western, mainstream culture, American culture. And I think it became this helpful branding point for them, for PIMCO and for Bill Gross, that, oh, he's doing this like very enlightened thing. He's very thoughtful. He's very California. He's very different. And I think that, this being is sort of like hilarious and ridiculous to think of this as being like kind of out there. But at the time, it struck people as so different. And it is also funny to me because while he did exercise religiously for a long time, when he stopped, he didn't feel compelled to update everyone. So this yoga brand persisted even when he wasn't really doing it, but he didn't really need to maintain it. It was just out there and a bit self-perpetuating. So this is also that kind of distance between his practicing yoga and being branded as doing yoga, the distance between appearing accessible and like kind of, these embarrassing anecdotes that are endearing and the true reality of interacting with Bill Gross, say, on the trade floor. I think that he was not aware of those gaps between what he was putting forward and the actual reality of being around him or the reality of his life. I don't think he was aware of that gap. And I think that distance and that dissonance was sort of, I think that's part of the seeds of his downfall. So the big break, PIMCO's like, entrance to the mainstream consciousness, I guess, would be the Great Financial Crisis. And as early as 2006, PIMCO saw the problems in subprime mortgage lending and in the housing bubble before everyone else. And, they had the mortgage team out in the world investigating home prices and creating relationships with mortgage brokers to try to keep a finger on the pulse of this. They also had Paul McCulley at PIMCO, who was, pounding the table about Hyman Minsky, who was kind of underappreciated at the time as well, saying, there's going to come a point when all of this risk-taking is unsustainable, when people have reached too far for yield. And that will create a Minsky moment, at which time prices will start to turn and things will spiral. And this kind of chorus came together to give PIMCO this insight. That things were going to turn, that the rally at the time was built on unsustainable foundations and assumptions. And indeed, they were right. But of course, that required them to be patient and wrong for a long time, which can be really difficult as an investment manager because, you're trying to explain to your clients why you're over allocated to cash. And they're like, I could just have cash myself without fees on top. Like, do you mind? It's a very difficult proposition if you don't have that institutional loyalty, that client loyalty, to hold on to that money while you're wrong. So, everyone else is still partying, raking in extra yield, and you're just like twiddling your thumbs waiting. So that was a painful period. But as Bill Gross said later, he'd rather be early and right than caught off sides. So in 2008, famously, everything happened. The September bankruptcy of Lehman Brothers, this was sort of the catalyzing moment where everyone was like, oh, this is really happening. This is a real thing. And PIMCO began to delineate between assets that were going to be under the umbrella of government support and everything that wasn't. And if it was going to be under government support, let's buy it and buy everything we can find. If it's not, it's not. Don't touch it. So just kind of thinking about what the government would deem too big to fail, it looks clear in retrospect, but PIMCO was pretty good at figuring out, okay, this one they're going to have to back, that one they're not. Let's not touch them. So that meant buying, bank preferreds and investing in the debt, in mortgage debt that other people at the time were basically terrified of because they realized that the government would eventually have to act to support Fannie and Freddie. So this is an on-the-record quote, which I find just amazing. He was, speaking about the U.S. government, he said, Bill Gross wrote, "Buy what they buy, only get there first." And I don't know about you, but that sounds like front running, just like definitionally. That sounds like, but they said this openly and on the record at the time. And again, a lot was going on. So I think it just kind of washed away. But this strategy was indeed the, openly articulated, just get there first, beat the government to what they want to buy, sell it to them, or accept the largesse of their backing that will manifest in higher prices. So, this was most acute to me. Kind of objectively, I think, in the case of Fannie and Freddie, where at the time they had directly or indirectly backed or guaranteed $5 trillion of mortgage debt, which is just bonkers. And I think, again, at the time, that was just not where anyone wanted to be. But PIMCO was perfectly comfortable, basically sitting down, taking that risk and saying, hey, government, do you mind? Do you mind just making explicit that guarantee, that degree of support and backing for these institutions, where previously it had been kind of unclear. It had been a little bit fuzzy. And indeed, in September 2008, the Treasury did what PIMCO had advocated and made that support explicit. And the day that news came out was the best day on record for the flagship fund. So, you can see that there's this weird relationship, this weird agreement between PIMCO, the biggest bond buyer, basically, and the US government, where, the mortgage market was the kind of epicenter of this crisis, and PIMCO is just sitting at the center of the mortgage market. And I think whether or not they wanted to, the US government had to listen to and quasi-government had to listen to what PIMCO had to say. So it's a really uncomfortable relationship, but it is, every government across the world, I think, has to make some kind of negotiation with capital markets, with the degree to which they're going to engage with capital markets. And in this case, this is the system we ended up with. This is what we found. And I'm not sure if we've re-examined that or if it's kind of only grown in that direction. So post-crisis is where the narrative turns from the mortgage market to a fable about management and culture. And, succession and transition, things that I think a lot of founder-led firms really have a hard time grappling with. So Mohamed El-Erian came in as PIMCO's co-CEO and co-CIO. And PIMCO had never had someone kind of straddle two sides of the business before. They'd long advertised themselves as a three-legged stool, as having very separate, distinct separation between client services, business, and investing. And they kept those clean on purpose, but also because their founders really took to each of those kind of departments instinctively and naturally. And it was sort of an accident. But then Peter Drucker, the management consultant, was like, why don't y'all make this part of your pitch and say to clients, we are doing this on purpose. It's a three-legged stool. And indeed, they embraced that and went with it. And I think it was to their great advantage. But when Mohamed El-Erian came in, kind of straddling two sides of the business, a two-legged stool is not a stool. And I think PIMCO would tell you that this is the first and last time that they would ever have a co-CEO and co-CIO. So in my view, I think this was sort of a structural curse on that relationship. Like, I don't think they actually could have had a successful transition given the structure, the way in which Mohamed El-Erian came in and the kind of roles that he had. This was also kind of a bump in the moment when he came on board in 2007, because Bill Gross and Bill Thompson, who was the outgoing CEO, they felt uncomfortable with that dual role. And they kind of didn't intend for that. They wanted him to be only Bill Gross's successor, not Bill Thompson's. I apologize for the number of Bills. It is far too many. But both Bills ignored their misgivings because they were really excited about having Mohamed El-Erian on board. So I think both from a structural standpoint and from an approach of how that came about, the relationship, in my view, was already doomed at that moment. So Mohamed El-Erian's job was to broaden the menu beyond burgers and bonds to find new products and growth areas. Burgers and bonds is what Bill Gross called the kind of core total return type of business. And Mohamed El-Erian was supposed to bring in, alts, ramp up the private equity business, the hedge fund business, maybe start an equities business. And I think another way in which this relationship was low-key doomed was the kind of just personality of Mohamed El-Erian and Bill Gross. If you know Mohamed El-Erian, personally or just publicly, he is polished, he's academic, he's super, professional and diplomatic and very, 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 very polite. And Bill Gross is, accessible and down to earth and like quirky and intense and like has really not a lot of time for the niceties and kind of politeness that Mohamed El-Erian will kind of pepper on every conversation. So I think there's a world in which those can be complementary, where those actually kind of amplify each other and work with each other well. But this was not that world. And I think that these differences started to accumulate and become frustrations. So one thing that I think is key too is that I think Bill Gross, when he was coming up and when PIMCO was coming up, his co-founders and his peers worked around him. And I think, in part this makes obvious sense because it's like they had the structure where the lanes were cleanly delineated and defined. So like, why would we need to interfere? But also like just let him be. There was a sense that he's this kind of particular person, like let him be. But as the years went on and as his kind of external legend grew, I think there was this weird dissonance that, again, I think he didn't notice, where he was becoming this like very powerful and important person, very famous person as he wanted. But the difference is when the firm doubled in ranks in size, both in assets and in ranks, it created this, he got elevated more. He's more influential, he's more powerful, and he's this kind of larger than life character. And I think all these up and coming PIMCO people were like, oh, hi, Bill, trying to build a relationship with him, making eye contact in the hallway, trying to speak to him. And that's just not who he is. He is shy, he's introverted, he's insecure. But those traits in a leader, in someone so influential and famous and important, I think can be translated as rude. And I think that was a little bit of another seed of difficulty to come. It also meant, Bill Gross, I think, never really viewed it as part of his job to maintain relationships with the other executives. I think he viewed most executives as like a suit who wasn't contributing to the bottom line and indeed was probably costing them money. And that was historically informed. His job had never been to manage people. He was supposed to be insulated from all that three-legged stool. But the relationship with Mohamed El-Erian did indeed deteriorate. And over the course of 2013 and into the beginning of 2014, they tried to hire a mediator. And Bill Gross said, oh, I would never agree to that, even though everyone had heard him agree to that. And it started to, after Mohamed El-Erian left, there was this big article. There was an article in the FT about how, yeah, he had said he left to spend more time with his daughter and, to focus on work-life balance. But really it was because of friction at the top, because, he wasn't getting along with Bill Gross. And this story it wasn't like a blockbuster. It was a well-reported story, but it wasn't like it didn't make a big splash. But the next story, the Wall Street Journal article, did. And I think sometimes things just hit different, but this one was kind of shocking, I think, for a lot of people in investment management who didn't know PIMCO that well and didn't realize the intensity of the trade floor and didn't realize the quirks of Bill Gross's personality that a lot of people felt they were working around. So this is where Bill Gross starts to really get fixated on who was leaking to the press. And this is also where you can kind of line my book up with public materials, which I think is fun personally. And maybe that's a journalist talking, but maybe that would appeal to you also, where you can say, okay, he has this talk on Bloomberg TV where he says, yeah, Mohamed, tell us why you left. And you can go watch that yourself. He called Jen Ablon then at Reuters and said, Mohamed El-Erian has you wrapped around his little finger. He wrote the Wall Street Journal article himself, which is not an accurate assertion. I'm sure he was exaggerating, but that's on the record. You can go read that. He gave a famous keynote at the Morningstar Investment Conference where he compared himself to Justin Bieber and Kim Kardashian and said that no place is happier other than Disneyland. And you can go watch all these for yourself. And there are some moments where I feel like my book is a list of facts. Because so much of the source material is public, but I do think that makes it fun to kind of get to, if you really want to go deep, you can do your own research, as they say. So at this point, this is continuing for most of 2014, and PIMCO's management is basically faced with this tough choice. He's becoming impossible to work with. You can't work around someone who flip-flops on all their decisions, and you can't, if you act based on something he agreed to, and then he says he never agreed to it, like, what are you supposed to do? So it's becoming increasingly untenable. And at the same time, Bill Gross is basically continuing to dig in. He's the founder, and I think at this point he's really testing the limits of his power and finding out that it's not as there as he thought. He never, power wasn't the thing he was indexing for, so maybe that's part of it. And this is the hardest part to report. People experience things differently and remember things differently, so I would have a meeting that I'm trying to report on, and people in the room have different memories of what people said. And so in the writing, I try to tell you basically when we're in Bill Gross's head and when we move out of it. And in part, that is because I didn't want to write a book where Bill Gross is a caricature, where anybody's a caricature. because that's not interesting. It's like very boring to read about caricatures, but also like I just wanted it to feel real, and I wanted you to come away with an understanding and a feeling for what Bill Gross was going through, what he was seeing in the world and in these conversations. And actually, it's been super gratifying to hear in the wake of publication that some people who had been in those same rooms were like, oh, maybe you're right. Maybe we didn't really hear what he was saying in this way or that way. Maybe like the way I remember and experienced it, maybe that wasn't a fulsome picture. Now that we read it in the book, maybe we, with the benefit of hindsight and calm, maybe that's a good point. Maybe he was trying to say something that we missed. And I think that's, as a journalist, that's like incredibly gratifying. But it's also like, I know it's been a very long time, so I have that benefit of distance, but it is like, it just speaks to the kind of ephemerality and like elusive nature of objective truth. As a journalist, you're always trying to achieve that, to try to get to the core truth of something that happened. But of course, what happened is what people experienced, and the only way you're going to get it, unless everything is taped, is via, the people who were there. So everything is sort of subject to that subjectivity. So PIMCO after Bill, the culture he built lives on. I think that it's not just the culture that flowed from his personality directly. It's kind of the telephone game result of that, the kind of derivative effect of that. And that's, a deep intensity and a kind of grueling schedule. I think they're working on it, but it's starting from a difficult base. They are also grappling with a lot of lawsuits about discrimination and a boys' club and kind of cliquey behaviors and advancement, career progressions. So I think that it's a difficult time anywhere to have, a very corporate and like, I think we're all renegotiating what we bring to work and how much of ourselves show up to work and, what we want from work. So I think PIMCO's, subject to that just like everyone, but I think it is a more difficult challenge for them, just given the kind of Salomon Brothers-y, Bill Gross-y culture that they do have. So institutional investors increasingly do care about that stuff and are asking, but it's very hard to quantify beyond kind of the blunt measures of, okay, what percentage diversity do you have in this way or that way? So that's a tall order, and they are working on it. But again, they had not had a Black partner, for example, by, January 2021. So it's like, how do you get there? How do you claim to have a meritocracy and have zero Black partners represented? I think it's just these ideas are really irreconcilable. So I think the firm ended up far more resilient, actually, than I think Bill Gross wanted. He sort of accidentally built an incredibly robust and stable company. It's sort of interesting that should be an enormous marker of success, but that's not the yardstick that he uses. That's not the way that he values things. He values track record in a fund. He values market performance, not, firm resilience and viability. So, Bill after PIMCO has been, I would characterize it as a time of increased volatility. His returns at Janus were not the same as his track record prior. He was not able to replicate the success that he did have at PIMCO through that structural alpha, making his sandbox bigger. He sued PIMCO for the kind of way in which he was ousted, and he got a very public, I guess, divorce. A lot of the details of it ended up becoming public, and it was very ugly. And he got more recently in a fight with his neighbor over a Dale Chihuly sculpture, which he and his new wife, Amy, installed in their yard. And it upset their neighbor, who complained to the city of Laguna because they didn't have the correct permits. And then that resulted in Bill and Amy playing Gilligan's Island theme song on repeat at all hours, and also Inda Club, and also the theme song to Green Acres, among other things. So that was unusual. And there was a moment in 2019 where I was trying to, maybe 18, I was still trying to ignore the new things that were coming out. The neighbor thing hadn't happened yet, but his divorce was in the headlines. And I was at a dinner party, and a friend was like, oh, a friend of everyone was like, is this the guy you're talking about? You're writing a book about the guy who left dead fish in the air vents of his wife's house. And I'm like, okay, is that how he's known now? I guess I have to change the book a little bit. I was reluctant to keep editing it, but he kept doing stuff. So I did keep updating the ending until I think literally the summer of 2021. So yeah, and then 2 weeks before my book came out, he published his own memoir, which again, I'm delighted you can kind of line up against mine and see the ways in which I move in and out of his perspective and see what you think doing your own research again. But that is, I think, that's basically the gist of where my book goes. And I think the kind of foundational tenets of Bill Gross as the bond king and the ways in which he shaped American finance, it's all in there. It's all kind of, these innovations and decades long dedication to making sure that he gets the true odds to reveal that strategy and to beat the system. Okay, do we have time for questions?
Thank you, Mary. That was an absolutely fascinating account, excellent summary of your book. We do have questions from the audience. Let me start with one. Tom Herman wants to congratulate you on your book. And he wants to know your thoughts on bond index funds. Do they work as well for individual investors over long periods of time as stock index funds have? And what would Bill Gross say about bond index funds himself?
He actually has this is a great question. I love it. Thank you. And he has long been a proponent, I think, of index funds in the sense that he is a big fees guy. He's like very much on this kind of hobby horse about making sure you negotiate fees down. And indeed, he says that it's one of the reasons that people ousted him from PIMCO was that he thought fees needed to go down more and he was threatening their bottom line. Take that as you will, of course. But I think, it's a tough time right now in bond markets. And there's a stronger argument now for an active manager making active human decisions about what to buy and what to sell when the market is selling off. If we are in kind of an increasingly volatile and like interest rate climbing, a new interest rate paradigm, that does kind of argue for a move away from index funds. But I can't in good faith say that because it does seem as though, fees have come down, but they're still very high. And in my personal opinion, that's very subjective, of course. But I think that, the cost of money has been coming down and there is kind of a natural rate of what we would charge for money, the cost of money in the economy. And I think that has been a long-term trend over many, many decades of getting cheaper and cheaper and cheaper. And it's kind of hard to argue, even with inflation right now, even with these kind of exogenous and seismic changes in the market, it's hard to say that like technological innovation won't continue to yield a declining natural cost of money. So I don't know. I would still kind of stick with some allocation to bond fund index funds. Not professional advice. Don't take it.
I'm going to expand a little on Arthur Said's question, asking about were you able to interview Bill Gross and Mohamed El-Erian? Now, obviously, I've read the book. I know several times in the book you talk about Mohamed's reaction through his lawyers. What was sort of the reaction from PIMCO, per se, from Bill, from Mohamed? And was it hard to do that? And, what did you learn from that?
I love this question. This is it was 7 years of like trying to wrangle people. It was not delightful. Bill Gross was super open. And I think this is actually interesting because like people outside PIMCO thought that Mohamed El-Erian would be super helpful and talk to me all the time. And Bill Gross wouldn't because it's not a nice story to Bill, that like it's, a harsh story for him. People within PIMCO knew that the opposite would be true, knew that Bill, I think, had more to gain from and wanted his story out there more, whereas Mohamed El-Erian had more to lose, where, the external perception of him was so good and that he's this like wonderful economist and very kind, and the internal perception of him is quite different. So I tried to talk to Mohamed El-Erian a lot of times over 7 years and, give him appropriate audience to weigh in on the book and also just like help shape the narrative. He's one of the most important people in the book, and I wanted to make sure that the narrative reflected his experience. And if there's something that happened that he doesn't tell me about, like how do I necessarily know what the big events should be? So I did my very best. He said no a billion times, and I did my best to kind of work around that and triangulate, talking to his friends and his ex-coworkers and his, people who've been close to him and, drawing on public records as well. And eventually in December 2021, the book is supposed to come out in 82 days. I get a note from a representative of his that he would like to speak. And basically they had obtained a copy of my manuscript, which is not how things go. There's not like someone had leaked it, which is extremely funny to me because I know what had sort of driven Bill Gross mad was the trying to hunt down the leaks for the journal article. So I knew better than to think too hard about it, but about where the leak had come from. But it was, I wouldn't have chosen this path, but it was very nice to get his notes. I got to see, where he took issue with my reporting and where he had things to add via his lawyer, which was great. That meant that both I could incorporate his thoughts. My publisher was super chill and nice about, very accommodating. The book had been typeset. Literally, we had been, the little letters are ready to thwack the pages and print. And we had to literally stop the presses and change that, which is enormous and affects like a billion different people. And especially with the supply chain stuff, it was like very scary. But we were able to do it and incorporate his views, and I think the book's a lot richer for it. Obviously, I always wanted his participation, and I'm so happy to have gotten it. And I think they're great notes. So yeah, heard from Bill a lot, talked to Bill a lot, sat down with him for many, many days, many hours, talking about his childhood, his investments, his all of it, and sat down with Mohamed El-Erian for 0 minutes.
How did PIMCO feel though? Did you get any?
Before or after?
How about both?
Yeah. So before, they felt very anxious. I think they wanted the whole thing to go away. Understandably, they just wanted to move on. Again, I get that, but there's a problem. I think I've actually never encountered a place that's more confused about whether or not I work for them. They very much have treated me in the past and in this process like an employee. Like I can just accommodate their schedule. And somebody asked me for a copy of the book before publication because he wanted to prep clients. And I was like, that's not how that works. You have to wait until it comes out. I'm happy to share it when it's out. You can buy a copy like anybody else, but it's not my job to help you prep clients. So that was weird, but I think they were anxious, and to such a degree that I was like, is there something I missed? My book has a lot of detail and drama, but I'm like, their behavior made me think that I really missed some enormous something or other. Let me know if you know what it is. And then in the aftermath, I think the actual book, both it's the uncertainty. Everyone hates uncertainty, right? Investors, most of all. So I think that just not knowing what was going to be in the book for 7 years was literal torture. But then it came out and they were like, oh, well, this is just a list of facts. This is just accurate. And I'm like, no, I know. Thank you. I worked very hard. So that was, I think, a relief for a lot of people. But I did hear that, work stopped, and everyone, the day it came out, everyone sat in their little offices just flipping. So, which is a great compliment.
Here's a question on market making. The question is from Thomas Callahan. He's asking, do you think that he had any responsibility to the bond dealers who provided liquidity and marketability for taking advantage of their market making?
I love this question. Channeling Bill, no. Channeling PIMCO, absolutely not. The dealers take advantage of you, and you should do everything in your power to wring basis points out of them and get better execution. There was this one meeting in, I think, right after the crisis, where they had just, news stories had come out that dealers were making record profits, and this enraged Bill Gross. It was just, if Wall Street banks are making record profits, then we are losing money to them, and that's our clients' money, and we need to get it back. So the institutional stance had long been that, a total scorched earth strategy for the most part of just trying to rail on your Wall Street coverage to get better execution, to reduce the bid ask, get a better deal. If they hit your bid, you paid too much. So I think the idea, that's arguable. I think it did actually work for PIMCO. They were so big they could do it. Other people struggle to do it because they're not as big, and so the information flow is not as valuable. Whereas, dealers need PIMCO to anchor a new issue, to be a participant in their markets, and PIMCO really does have the power in that relationship. So, one wishes they were nicer about it, but I think structurally there's not a lot. Bill's just not gonna pepper you with niceties. He's just going to get the best deal he can. And if that means totally scorched earth, that's what it takes. That's what's good for the client.
Often in the book, money, power, fame comes up. And we have a lot of students on, and I think a lot of Wall Streeters probably wouldn't have said fame. They probably would have said money, but I'm wondering, are these corrosive? And how do you feel? You've been interacting with these three triads again. How do you feel about it? What are you thinking?
Yeah. I love that question. I think it's a funny framing, right? As a public radio journalist, I think I chose none of the above. So it's a bit foreign to me to think about the world in that way, but it is clarifying, right? And I think you're right. it's an unusual, you don't have as many people indexing for fame. I don't, even the biggest bold-faced names in our industry now, I don't think anyone is, I mean, Jeffrey Gundlach is like the most famous person I can think of in the bond market right now. And like, he indexes for money, I think, or influence, you know. I don't think that fame is on his list. So it is weird. I do think you're right about the corrosive nature. You know, one thing that I thought was interesting was that Bill Gross seems to think that the other two are bad, like are deleterious or less moral in some way. You know, he says that the cabal that ousted him was motivated by money and power. And he said it to me like it was like they did this bad thing. They weren't motivated by fame. And I'm like, is fame the pure one? Is that the one that's like of good heart? And maybe it is. Maybe there's some built-in accountability because if you're, you know, it's a type of fame. If you're infamous versus famous, I'm not sure. But it does seem, I would say that, yeah, all of these are a bit corrosive and maybe we should look outside that framing for motivation and for ways to kind of feel any accomplishment.
Mary, the title of your book already hints at two dramatic stories. The first dramatic story is how Bill Gross built an empire. And the second dramatic story is, in your words, lost it all. Taking a cue from one of the questions from the audience, I'm thinking whether it's, and I know this is not an exact parallel, but I'm thinking of another person who also built an empire. And at one time, his company had the highest market cap. And eventually, after he left, that empire shrank a lot and recently spun off into 3 separate companies. I'm thinking about Jack Welch and GE. And I don't know if you have thought about it already. Certainly, this is not an exact parallel. But
you mean this guy? Just to say, yes, I haven't read it yet, so I don't want to weigh in. Yeah.
But Jack apparently was told by his mother at a very early age to always be supremely confident of himself. And I don't know whether that was true for Bill Gross also or not. Your quick thoughts?
Yeah, I mean, I think Bill Gross got the opposite treatment from his mom. His mom was always kind of, I don't know, undercutting him. Like there's a bit of this unpacked via his investment outlooks in the book where he, you know, he's like, is this good enough yet, mom? Like that's the vibe. So I think it was sort of the opposite structure going in, but the outcome was a bit similar but like insecurity manifests as public confidence, right? Like in this kind of like overshoot to mask the other half of it. So I think, you know, you can end up with basically the same outcome of this like swagger and projected confidence. But I think, you know, the way you get there might be a bit different and maybe that changes the outcome a little bit. But yeah, I think this like kind of dogged pursuit and like overconfidence in your strategy and in the idea that what you're doing is good, it does seem to have had a deleterious societal effect. So yeah, I don't know. I guess that I believe in being confident and moving through the world with confidence, but maybe knowing where the line is of what's too much. I don't know. Very important parenting question.
Thank you.
Yeah, for my final question, and it's for all you who want to read this ebook, because you listen to Mary and the voice that you hear is very similar. Like it's a very enjoyable read is what I said in my opening comments. And I'm just wondering, it's a bit unusual. Maybe it's your background and your reporting background, but is there anything special about it? It flows. It's like listening to you.
Oh, thank you. I mean, that might be just by virtue of like editing it a billion times over a billion years. Like I just had the earlier drafts were less good. And like I think part of the reason it flows so well is because I and you know a bevy of editors helped to kind of reduce it to like a concentrate, you know, it's like a reduction. It's been boiled down. And I think that's, you know, that's the work that's necessary. And like if, you know, if I hadn't had all that time, it would have been much longer and much worse. So part of that is just time, but it's also like I think the corrosive, like the way I was treated, like I just talk like this anyway, but I think I also felt liberated in being more voicey because it was like, I need to deliver this message to you. I need to tell you honestly what I found. I spent 7 years learning this, and I need to like shortcut that to you. I don't want you to have to like dig through all the stuff that I dug through. I want you to get there. So part of it is just like expediency.
We got there. Thank you so much.
Thank you.
Sarish?
No, I have nothing to add. David, would you like to tell our audience about
this likely concludes for at least this spring term here for us. We've enjoyed having all of you. We've got a lot of programming already starting to be lined up for the fall, but we always want to thank all of our guests, all of our partners, the CFA, our friends at Fordham, and especially our friends with the museum and you, the audience. So thank you very much, and we hope to see you again soon.
Thank you, David.